Thank you, and thanks to the organisers. It's a great conference and certainly lots of activity. There's been a lot of activity at Aspire too since I was here last in April. Just quick rundown. Aspire's three assets. One, the Evoot Coking Coal project, which is an enormous world-class discovery of ourselves back in 2011, 12 and 13. It's a discovery from the last boom in the coking coal market. The coking coal market has now recovered and it's opening up new development opportunities for us. We have a rail concession with the Mongolian government, build, operate, transfer 30-year licence to build a railway connection to Evoot, which has now been made part of One Belt One Road, and I'll talk about that in a while. And during the downturn, we also bought very cheaply high quality but smaller hard coking coal project called Nursty, all in the north of the country. What's changed for us dramatically since we were here last is we had our share price has tripled, and there's an enormous volume, as you can see there, that happened in May, June, July of this year. That was principally because a Mongolian national by the name of Mr. Teren Putzag came in and bought 16.4% of the company on market, and subsequently entered into negotiations with the company about taking a further interest. We completed that negotiation recently, and there is a shareholders meeting pending next month whereby we've agreed, subject to shareholder approval, for him to take another interest in the company, take it to 27%, and agree a 2-year standstill. He won't go above that for that period of time. He'd also put 2 directors on the board. We see this as a fantastic opportunity to, one, align our interests with significant Mongolian interests. He is very well connected, and we're both completely aligned in what we're going to do, which is start an early development of the Evoot Coking Coal project. For those who've been in and out of Mongolia and know the history there, having a third of the company Mongolian nationally owned, really, really important, valuable. And an interesting observation, we're an ASX listed company and they're seeing it as being beneficial to invest through an ASX listed company to buy into assets that we have. We're a company market cap of around $60 million Australian, 45 US, which is still very, very small in the scheme of things, yet we've attracted some large partners over the years because of the quality of the assets. So Mr. Teren Putzag came in because he saw value. Noble Group has been with us for 5 years and is both a partner with us in the company, owns 20%, and also with the rail company, 20%. And then we're partnered with the Chinese government entities, 2 large EPC contractors, China Gazuba Group and China Railways Construction Corp, and China Development Bank is there supporting the EPC contractors. What we're going to do, and we've agreed with Mr. Putzag, is to actually target fast-track production of the Evoot project, focusing on a road-based connection to the mine. So pre-rail, a road-based connection. Very important for us in that we've identified a high-yielding, low-ash, low-strip ratio starter section of the ore body. So we are going to high-grade the ore body, but we're talking about just 10% of a 247 million tonne reserve. The idea would have a private haul road, which you're able to use large capacity trucks to keep transport costs down, such that the end cost, FOB cost, is competitive with if you otherwise had rail. It will take approximately 12 to 15 months to build the road at the conclusion of permitting, and that's something we're looking to progress with and have ready to commence in first half 2019. For Aspire, at 3 to 4 million tonne per annum of capacity, it makes us a globally significant coal producer very quickly with a minimum amount of capital. Obviously brings forward production, but more importantly, it actually helps us fund the medium-term rail development outlook and to help us get to where we can be, which is 10 million tonne per annum, which is obviously a very large coking coal capacity. Coking coal is a good market at the moment. It certainly suffered a lot in the downturn, and I can tell you even now, even with the coal prices where it is at plus $200 a tonne, you wouldn't be able to replace the Evoot project. We would not be able to raise the exploration capital required. We've put over $50 million in this project back in the boom times here. And it's not just us, it's everyone. So what's happened is there has been a significant underinvestment in coking coal market to the point where some small variations in supply is having quite a big impact. There are 2 good-sized mines, one called North Goonyella in Australia and a couple of mines in Alabama who have had to shut production the last 3 months because of various issues, technical issues. And that's just 2% of the global supply. And the pricing is really pushing up because of it. And it just shows there's no slack in the system at the moment. Overall, global steel-making coal growth is still expected to be quite strong, driven largely by India. Most of the growth is India. Japan and Korea flat. But China, interestingly, is still modestly increasing its imports. With the Yavut project, it's a well understood asset. We spend, as I said, a significant amount of money over the years. It has a mining license, which gives us a 30-year tenure. It has reserves of 250 million tonnes. It's a very large asset and can be developed up to 10 million tonne per annum. Most of the resources are in measured category. As I said, it's well understood. It actually forms part of a larger basin, but the Yavut open pit is actually one single open pit, 5 kilometres long, 2.5 kilometres wide, 300 metres deep, 7-to-1 strip ratio, seams up to 40 metres thick. It's relatively straightforward in that respect. But what it does produce is this something they call fat coal, which is a blending coal. So it has properties down here being particularly good fluidity, dilatation and blending characteristics, which means you put this coal with coals that have no fluidity or low fluidity and create good coke. And we're able to do that in blend tests with some other Mongolian coals that aren't coking and able to blend it with Yavut and come up into the hard coking coal category. That's sort of the magic of what this particular product does. It's not a product that comes out of Australia. It is a product that comes out of the newer, fresher coals out of Mongolia, parts of Russia and parts of northern China. There's also sometimes an assumption that Mongolian coal, because Mongolian gets a discount, and it does get, the actual average price received by Mongolian coal producers is lower than you'd find in the seaborne market, mainly because all that coal actually gets exported out of these border points here in southern Mongolia. These green dots here are where the steel mills are. So the main markets aren't where the coal's coming out of, and in this case it's 1,700 kilometres to that main market. Out of Garan Sukat, it's 1,200 kilometres. Yavut coal will be coming out through this line here, which is somewhat closer to Ernet Tangshan and Tangshan, where the most of the market is. And just to show, on the same day, prices at each of these different points, at Seki border, at Guajamoto Garan Sukat border, and at the same time in Tangshan, Mongolian wash coal and Australian hard coking coal all get equivalent pricing. So my point I'm trying to make here is, if you deliver the right product in the same market, you get the same price. There isn't a price discount for Mongolian coal, neither should there be. It'd be illogical. Although there is a discount, I'd suggest, for Mongolian coal assets at the moment, because it needs the infrastructure to be able to realise these particular prices. With the Yavut Early Development Project, what we're looking to do is build a comparable road along a rail path. We've received a feasibility study from China Gazuba Group 3 months ago that identified a service road, which we've been doing some preliminary work on to see if it can be created into a haul road. That preliminary work's being developed into a full scoping study, which will then form the basis of a feasibility study, which we'll have completed by March next year. We've looked at terminals. We've bought a terminal area at Erdenet, which will be able to take the full amount of capacity, and we've also had confirmation of existing rail capacity along here. So we can deliver into 3 to 4 million tonne per annum capacity, and we'll be designing the mine to do such that. So in conclusion, Yavut's a highly strategic asset. Fat coal sources in China are getting deeper and harder and losing some of their fluidity and properties that makes them fat coal. So we're well placed to deal with that. We've got an experienced board of directors supported by key Mongolian shareholders now, who have only over a third of the company. It will put us in good stead with dealing with the Mongolian government and local communities. We're a near-term, high-value, low-cost producer of saleable coking coal via the Avut project. We have a rail subsidiary, Northern Railways, which has that concession, which is actually part of One Belt, One Road, which means funding sources open up in China. And the reason why we're here is in this map here, there is 65% of the entire world's steel-making industry is on that map, and we're right here. It's really about solving the infrastructure solution to realise this enormous latent value we have in Avut. Thank you.